The Indian stock market stands at a crucial turning point, with the Nifty index attempting to breach the psychological level of 21,000. Some analysts believe this milestone could trigger a new bullish phase, while others warn of a potential significant market downturn. Underlying this are threats of a global recession, geopolitical tensions, and a potential bull trap, suggested by technical indicators. This report analyzes the economic forces, investor sentiment, and technical patterns that could influence India's financial markets in 2025. The enigma of Nifty 21,000. Understanding the psychological level. Nifty 21,000 is not just a number. It reflects the collective mindset of investors. Currently, significant options trading and hedging activity are observed at this level, indicating that institutional investors are preparing for potential volatility. Historically, such round numbers have proven critical for the market, experiencing higher price fluctuations. Key stocks driving the index. The Nifty's direction heavily depends on its top companies: Reliance Industries, HDFC Bank, TCS. These three companies account for over 35% of the index's weight, making their quarterly results highly influential on the Nifty's movement. Recent reports show Reliance recording a 7.38% profit increase, while HDFC Bank's profit rose only 2.31%, raising concerns about consumer credit health. The reality of a bull trap. Deceptive market structure. The 2022 decline in the S&P 500 was a classic example of a bull trap. The index rose from 4,100 to 4,650, but later fell by 20%. Technical analysts see similar signs in the Nifty's chart. Failure to sustain above 20,800, declining trading volume during the rally, declining RSI, indicating weakening momentum. Many experts have explained how retail investors get trapped in fake breakout patterns. To avoid these traps, it's essential to analyze volume, understand moving average convergence divergence, MACD, comprehend candlestick patterns, vulnerabilities of retail investors, key mistakes made by retail investors, recency bias, overemphasizing recent market trends, confirmation bias, seeing only signals that align with their views, herd mentality, chasing rallies without fundamental analysis. With the rise of free trading platforms, new investors are particularly at risk of falling into such bull traps. Threats looming over the market, global economic challenges, several recession indicators are currently visible. Yield curve inversion, historically a reliable recession indicator, declining consumer spending, reduced retail sales in the US, geopolitical tensions, trade wars and energy crises. The US economic situation remains a concern, with projections that the country's debt could reach 130% of its GDP by 2030. Indian market challenges. India may also face significant issues. Pressure on the banking sector, rising NPAs in MSME loans, high valuations, Nifty's PE ratio exceeding historical averages, selling by foreign investors, institutional investors selling large volumes of shares. Increased put option buying also indicates institutional investor caution. Market defense measures. Smart investment strategies. Expert advice. Invest 10 to 15% in gold and silver safe assets during volatility. Shift to defensive sectors. Prioritize healthcare and utility companies. Balance the portfolio review quarterly. AI-based market analysis firms also suggest considering fundamentals, sentiment, and macroeconomic factors when evaluating any company. Volatility avoidance measures. Maintain cash reserves. Keep 5 to 10% of the portfolio in liquid assets. Use options, strategies, buy protective puts to hedge against potential declines. Dollar cost averaging, continue investing during market downturns. Technical analysts believe viewing data across various timeframes is essential for confirming a genuine breakout. The road ahead. Technical analysts have identified two key levels. Bullish scenario. If the Nifty closes above 21,300, it will signal strength. Bearish scenario. If the Nifty falls below 19,800, it could drop to 18,500. Key economic factors to monitor. Monetary policy, RBI's balance between inflation and growth, corporate earnings, quarterly results, and company fundamentals. Global capital flows, the impact of Federal Reserve policies on foreign investment. Experts believe patience and discipline are investors' greatest weapons in a volatile market. Whether Nifty 21,000 marks the start of a new high or a trap, it depends on investors' understanding and strategy.